This is all driven by you all, so whoever wants to start off with a question, go ahead. And don't everybody ask one at the same time now.
I was hoping to start with chapter 2.
All right, sure.
That's where I guess the problems will be.
That's one that'll be one of them. Yes, yep. On margin long and short sale positions,
Yeah. So
in particular, where homework, pardon me, homework problems, applications, any.
yeah. So I'm looking at. Let me just pull it up to make sure that we're on the same page. So I was hoping to look at number 19, and this is coming from the Connect midterm practice problems for the midterm.
Okay, great.
Read it out if you need me to.
I should be able to do that right here. Hang on just one moment. Let me get out of the way. All right. And I think you said 19. Is that right, Nick?
Yeah. So it's margin call price and account equity.
All right. Okay, so we've got. Can everybody see that reasonably well?
Yeah, it's a little blurry, but it's enough to see it.
Let me go a little bigger. All right. So you short sold 400 shares of stock at 41. So 400 shares at 41, and an initial margin of 70%. If the maintenance margin is 35%, at what price will you receive a margin call? So maintenance margin 35%, and then also, so what is the call price, and then what is your account equity at that price? All right. So the way I would approach this problem is, let's see where I want to go with this. I think I want to go here. Hopefully this thing will cooperate with me. So you can use the formula if you like, and that's a plug and chug. Let me show you an alternative means, and that is simply by using the margin formula, which is margin is equal to account equity over value of the position. All right. And let me just clear that up. So we're going to start off, we're going to figure out what the price is first. So what I would do is I would start off with that maintenance margin of 35%. And I know that that's going to be equal to that account equity over the value of the position. What I need to figure out first, though, is what is the value of that position. So the value of the position would be, let's see, let's go down here. 400 times 41. All right, and actually, let me scratch that a second. Let's just do this. 400 times 41 is equal to. Okay, so this is not cooperating with me. Sorry, my apologies. Times 41 equals. What is the problem here? All right. This thing is usually quite good. $16,400. So that's the value of the position. Now we have to put in, that's when we open it, right? We have to put in 70% of that of our own money. So I would just multiply that by 0.7. So that means we have to put in 11,480. So the total of our total assets are going to be 27,880. All right, and we know that that's a cash balance, and that's going to stay 27,880 unless we get a margin call and deposit more money in there, right? Because if you remember the T account, the left-hand side is the asset side, and that's just cash because we're borrowing these shares, selling them, generating cash. Then we're putting our own cash into this, the 11,480. So that 27,880 is going to stay the same. The right-hand side, the liability, is what's going to change in dollar value because that's 400 shares. And as the price goes up, the dollar value of that is going to go up. And that means that our account equity is going to go down and vice versa. So we've got the dollar value in our asset account. And so then we can figure out, now we can go back to this formula where we're going to take 0.35 times, or 0.35 is the account equity, which is 27,880. This is assets minus liabilities. And that liability has to be stated in terms of shares. And we're going to put the price there. Let that be a variable. And then we're going to divide that by the value of the position, which is, again, stated in shares. And we're going to have multiplied by P, and then we're going to solve for P. So what I can do here is I can say 27,880 divided by 400P, and then this, right? And I know that that right-hand side, or that right-hand term, is equal to 1. So I've got 27,880 over 400P minus 1. I'm going to move that 1 over to the other side by adding 1 to both sides. So I've got 1.35 now. Over here is equal to 27,880 divided by 400P. And then I'm going to multiply both sides by 400P, divide both sides by 1.35. So that just moves these guys around. 880, and that is 1.35. Now I can do that division on the right-hand side. And 27,880 divided by 1.3, 27,880 divided by 1.35 is, I get 20,651.85. So this equals 20,651.85. And then I divide both sides by 400. So P is equal to 85 divide by 400. And when I do that, I get $51.60. Let's round it to 3. 62.96, or sorry, 51.6396 is the exact figure. So that's one way of doing it. The other way is to simply go over here to the formula sheet. Cheyenne. And since we're doing a short sale, this is something to be very, very careful about on the exam, right? There are two formulas for figuring out the price at which a call will occur. One of them is for a margin long position, and that's this guy right here. And notice at the very top, it says for margin long positions. then go down here. But we're in a short position. So we want to use this formula right here. So we should get the same number that I just got. We take our initial margin deposit plus the short sales proceeds. That's at 27,880. Divide by the number of shares. Let's see. Let me just do that math on the calculator here. 880 divided by 400. I get 69.7. And then I divide that by 1.35, which is 1 plus the maintenance margin. And yep, I get the same thing, 51.6296. So $51 and about 63 cents. So 2 ways to approach it. This one clearly in exam setting is faster. Just be careful. 2 things to be careful about. One is make sure you're using the right formula for P star, because there are 2 of them. The second thing to be careful about is, when you're doing your entry here, that you enter the right figures. Maintenance margin is in decimal form, so that's 1 plus 0.35 in this case. And once you've been careful about that, you should be fine. So probably for the midterm, I'd use this formula if I were you, unless you're really quick at doing the algebra. Either one will work. Does that help on that part of it?
Yeah, I just don't understand how to get the short sale proceeds. Can you go over that again?
Oh, sure. Yeah, and that's something that is going to be the short sale proceeds.
Because it doesn't give when we sell it at.
Let's see.
Probably.
Yes, that's correct. But you always, because it's a short sale, you always sell first, and you sell right away. And so our price was $41 when we did this. So we can assume that on the asset side, we have 400 times $41 is equal to, what did I get, about 16? Let me just do that. 400 times 41. Yeah, 16,400. $16,400. So that's before I put any of my own money into this. And remember, the broker is going to require us to put money into this, even though it's generated money itself. We don't have anything at stake. So if the price goes up, the broker won't have any money sitting around to cover the position if need be. So we have to put in the initial margin. In this case, it's 0.7. It's 70% of the value of the position, right? So 70% of the value of the position is, and the value of the position is 16,400. So we solve for X, and it turns out that X is equal to, let's see, 16,400 times 0.7, right? So I get 11,480.
Now that's the initial margin deposit, right?
Mm-hmm. Right.
Okay.
And so I put that in here. Now on the asset side, I have the sum of these two. This is my short sale proceeds. This is my margin deposit. The sum of that adds up to this 27,880. And remember, this is in cash dollars. So that's going to remain the same unless there's a margin call. And we really haven't gone over that part of the process as we've looked at these problems. So don't worry about that part of it. Just assume that this is going to be a constant. This is our equity stake. And then our liability is stated in shares. So it's 400 shares. Right now, when I compute that, when we first open the position, the dollar value of that liability is 16,400. And so now I've got the balance sheet, everything balances, and the world is good. All right. So now I could do this same problem here now that I know with my maintenance margin of 35, and I know what the price is where I'll get the margin call. That's that 51.63 approximately, right? So the next question is what is my account equity at the time I would get a margin call? So that is, let's see if I can clean this up. There we go. Cool. Okay. I wasn't sure this app was going to work well. It has ads in it and was giving me problems earlier. So at that price, I still have this 27,880 over here, right? And that's dollars, and that's my asset. And I still have the 400 shares liability. Now the question becomes how much of the 27,880 is left after I satisfy that liability. So the dollar value of that liability, the 51.62, what did I say, 96? Is that right? Does that ring a bell? So that's my that 51.6296. That's my price at which I'll get the call. All right, so that times the 400 shares, the dollar value of that liability is now gone up to $20,651.84. So that tells me that the assets minus liabilities is my account equity. So I simply take the 27,880 and subtract from that the 20,651.84. So let me do that, 27,880. And that tells me that I'm going to be left with $7,228.15 in my account equity at the time that the margin call occurs. Remember, I started off with what, 11,000, where were we? About 16.4 times 0.7. Yeah, 11,480.
So could you use if you weren't going to use the T tables, that one formula margin equals account equity divided by the value of stock? Would you just, with the margin in this case being 70%, do you use that, or do you have to use the table?
Well, what you could do is you could simply use this formula, assets minus liabilities equals equity.
Okay.
Right, and you know from your earlier calculation what the asset is, and then you know what this price is, so you can calculate the dollar value of the liability just by multiplying by the 400 shares. And that's going to give you your, and the answer is that if you showed me this or if you showed me this, both answers are correct, obviously.
Okay.
Whichever way you're more comfortable with.
All right, yeah, that makes sense.
Any other questions about this problem, either Nick or from anybody else? All right. Anything anything else in line with this stuff, with the margin long or anything else with the short sale? I think probably coming up with the call price and then figuring out account equity is the toughest part of that. But if there are any other questions, we could go over those right now.
Could you go over number 22? It has to do with a margin account as well.
Yes, but 20 and 22 are the two questions where we've canceled, right? So,
Okay.
however, we can look at here's why I canceled it is that I disagree with the way that the authors show calculating the interest cost.
Okay.
So if your question is related to interest costs, you can completely forget about that stuff because I believe they have done it backwards. And just to prevent any confusion on your parts, I'm just dropping that entire subject. So I apologize. I put those problems in there, and before I could get in there to erase them, somebody had already started working on on them, at which time Connect locks me out from canceling problems. So
Oh,
sorry.
okay.
But
So is that,
we could look at it for the rest of the problem if you'd like.
well, I was just gonna ask, do we have to know how to find, or like, is there gonna be a question asking about like the interest? I was just a little confused how like that is incorporated into the dollar return, unless we don't have to know about it, then you
You
can.
don't have to know about it because,
Okay.
like I say, the book is counter to my priors about how you do that, and counter to about every other way that we calculate interest.
Okay.
Um, and so, to avoid confusion, now what I would ask you to know about is what is, if you see a definition of something along the lines of the rate that brokers charge for borrowing funds from them, you would
Okay.
know that that's the call money rate, right?
Okay.
Um, but other than that, you don't have to know how to actually calculate that.
Okay. Thank you.
Sure.
Dr. Elliott,
Yes.
what exactly would which way would you have calculated the interest rate for that problem?
The way they do it is assuming that the stated rate is an effective rate. I would have done it the opposite, assuming that the stated rate is a nominal rate. And so I would simply divide it by however many periods there are in the year. So if we had 6-month holding period and a 12-month rate, I would simply divide that by 2, and I would get 6%. And then when I'd calculate it on that basis. That's the way every other loan is calculated. And as far as I can tell, I've done some digging around because this particular part of the passage in the chapter bugged me. And I've been digging around on brokerage websites, and that's the way everybody else calculates it, is assuming that the stated rate is nominal rather than an effective rate. Because the way the authors do it is they say, well, hey, this is an effective rate. So they take 1 plus the 12%, so 1.12, raise it to the 1/2 power, and then subtract off 1. And they get something less than 6%. And they apply that to the loan balance. That's just that's not right. So
Okay, so we would just only really be doing the effective annual return for actual returns, not for anything to do with interest.
right, yeah, and yeah, I'm glad you brought that up to clarify on Carrie's question too. Um, yeah, the only time I'm canceling anything to do with interest is for the call money rate on margin loans. Now, there is other things I think it was also out of chapter 2, where you had a periodic return over a 2-month period, and I wanted to see the annualized version of that you will still have to do. So that's where you would take, 1 plus your 2-month rate, raise it to the 6th power, and then subtract off 1, and that's going to give you your effective annualized rate.
Okay, so it'll be clear tomorrow though which one we need to do.
Yeah. I mean, the other ones are all okay. The way the authors present them is just fine. It's just for the call money rate on margin loans that is bizarre. So all of the other stuff they do is perfectly right. Yep. Thanks for the clarification. It's a good point. You still need to know how to calculate an effective annualized return.
Okay, thank you.
You're welcome, Nelson. Anything else on chapter 2 in particular before we
Yeah,
move
I
on?
was hoping you could do 23.
Okay, sure.
Because it's kind of similar, but
Right. All
a
right.
little bit, yeah.
Let me go back here. Okay, so this one says, I'm just jotting this down so when I move away from the slide or from the problem, I've got the numbers. Okay, so we short sold 800 shares of Wetscope Inc., a fledgling software firm, at $60. So again, back to your question, Nick, on the last problem. So the proceeds from this short sale, we can already calculate, right? That's $850 times $60 is 51,000. And yeah, so if I do that, I don't know why this thing is having such a hard time reading my writing. There we go. So there's your sales proceeds. And all right, so then we have, you cover your short when the price hits 50.55. Okay, so 50 50. And that's 1 year later. And if the company paid 67 cents in dividends over this period, what is your rate of return on the investment? Assume an initial margin of 55%. All right. So there's a lot to unpack there. Let's go with the initial margin so that we have a total dollar value on our asset side of the accounts there, or of our balance sheet. So this position is worth 51,000, and we are going to deposit 55% of that as our margin. And so that's 28,050. Okay, so the total amount in our there we go. Come on, stop that. Boy, this app is usually quite awesome, and it's being a real pain tonight. So we have $79,050 in cash in our account. And right now, $28,050 of that is our own money, and $51,000 of that was generated as a result of the short sale. Oh, go ahead.
That 79.50 is the equity.
No, 79.50 is the if I were to do that as a T account. Oh, here's the ad. Go away ad. No. Stop that. All right, I got to find another Blackboard app. That does not work for me. 79.50 is our asset side, and that's in cash. We've got a liability of 850 shares, and that means at the time we open this account, we have 28,050 in equity, and the dollar value at the time we open this account of the liability is 51,000, and that's at $60 per share. And we could continue on that pathway. And again, remember, this asset side is going to remain $79.50 because it's in cash. Doesn't matter what the share price is, it's the liability that's going to change. So we could continue on and actually calculate our profits by using this T account. So if we cover our position at $50.50, so that's 850 shares that we repurchase at 50.50, and so that gives us 50.50 times 850. That is a dollar value of 42 and 925, 42,925 is the dollar value of that. So our equity account has 79,000 minus, or 79,050 minus 42,925, and 79,000, and that gives me 36,125 as the balance in my equity account at the time I close out the position. So now I have the two most important figures that I need to do the calculation here. But I've got one more thing I still need to deal with before I actually get to a return. Anybody know what that is?
You add the dividends?
Yes, thanks, Nick. Yep, we need to take care of the dividends. And remember, since this is a short sale, since this is a short sale, we have borrowed those shares from another party and sold them to the market. So that other party is expecting to be made whole. So this would be a cash outflow from our account to pay that other party that we borrowed those shares from the dividend. So this would 67 cents per share, 850 shares. So 850 times 0.67. We owe that other party $569.50. So we subtract 569.5 from that, and we end up with, I got 35,555 and 50 cents. Somebody check my math there, if you would, if you're following along, I hope. Does that agree with what you get?
I got 35,555.50.
Oh, great. Okay, perfect. Thank you. Thanks, Nick. Okay, so that's our gross proceeds from this. So now we have, we've taken care of the dividend payment. Now we can go about calculating our net profit and then our return. So we've got, let me just jot this down before I erase the board. 28.50. Okay, so we've got that $28,050 was our initial investment. Remember, the amount of our margin deposit is what we consider our initial investment. And then we have gross proceeds of 35,555.5 after we close out the position. So let's, all right. Where's the X out of this sucker? Oh, I got one more second. Sorry. I'll get a new app before we do this again. All right, so now we just have 35,555.5 minus the 28,050. That gives me $7,505.50 as my net profit. So now my return is 7,505.50 divided by 28,050, which is my initial investment, also the same as my initial margin. And what's that give me? $26.75.7, or actually that rounds to 8. So that's 26.758%. And since this is over a 1-year period, I don't even have to annualize it. Luckily, if I did need to annualize it, then I would use that compound, the effective annualizing formula. So if this were over a 6-month period, say, instead of a year, I would do 1 plus 0.26758 raised to the second power minus 1, and that would give me that would give me 0.6067 or 60.67%. All right. Just for, sorry.
Effective annual rate always raised to the second power, right?
If it's 6 months. If it's 1 month, raised to the 12th. If it's 2 months, raised to the 6th, and so on.
So if it was for 1 month, you would do
12.
Yeah.
Mm-hmm.
Okay.
Yep. So it's always the 12 over the number of months in your holding period.
Okay.
Hmm?
All right.
Yeah, that's another good one, because if you can do both of those in that first problem we did, you should be in pretty good shape. Any others out of that chapter while we're in chapter 2? How about anything else?
I do have a question.
Okay.
On chapter 2. It's number 21.
Uh-huh.
So in the problem, I believe it's in an year problem where you have to divide the months by, I don't have it in front of me, but I have to divide the number of months, 12, by 4.
Uh-huh.
So that you're actually just cubing the function.
So this is an algorithmic problem. So you may have had 4 months, but this one that I just pulled up has a 5-month holding period. Yeah. So so you're asking about this right here, right? When you annualize it.
Yeah. So why would you do 12 divided by 5?
Because the holding period for this is 5 months. Now, in the problem that you got, it probably said 4 months, so it would be 12 over 4. If it was 8 months, it's 12 over 8, and so forth. So now, if you have something that's a holding period of greater than a year, then it would be, you could, if you're doing it in months still, it would be 12 over the number of months in the holding period. So if it was a 2-year holding period, that'd be 24 months. So it'd be 12 over 24. So there you're actually taking the second root. So that's also the same as raising to the exponent 0.5, right?
Oh, okay. So it's like when you're dealing in months, you change the 1 over n to 12 over n.
Yes.
Okay.
Yeah.
That's all I need.
Yeah. The other, you're probably talking about a formula where you're going from multiple years to a single year. Is that right? 1 over n. Yeah. Yep.
Thank you.
Mm-hmm. Sure. You're welcome. What else? Out of chapter 2 or anything else? And it sounds like maybe we've got all out of chapter 2 that you have questions about.
While we're on the year,
Mm-hmm.
I guess if nobody else has anything, for problem number 38, I just had a question, not really, just trying to understand how you did it.
Okay.
So on problem number 38, I'll wait till you get there.
Is that the one?
Yeah.
The Miller-Moore equine? Yeah.
Yeah. So for the stock return ones, those are pretty simple. That's what we just did.
Right.
And then the option is pretty, for the 66, it's always going to be negative 100. So that's kind of like a gimme, right?
Right. But let's review that, though, before we go on to the other one. So anything, if this is a call option, right, we have the right but not obligation to buy that thing at the strike or exercise price. And in this case, the strike price is $70. So we have the right but not obligation to buy at $70. That means that, and we're given 2 different prices. One is 76 and the other is 66. Anything below $70, if the market is below 70, and the way I think about these is I've got two different venues, if you will. I have the option whereby I can buy the shares, and then I have the market where I can sell those same shares. So if I can buy them at 70 and sell them at a higher price, I'll do that automatically. If I can buy them at 70 and the market's below 70, I won't even buy them. So that's why, and at the end of 6 months, my option is over. It expires. So that means that I've lost my entire investment, and that's why we're at a negative 100%. The other thing to keep in mind is that negative 100% loss is one of those weird situations where when you annualize it, you don't have to do anything. It's 100% loss. It's not a 200% loss. It's merely 100% loss. So even on an annualized basis, nobody ever doubles it or plugs in any value. So that's why, even though this is on a 6-month basis, the annualized return on a $66 share price with a strike price of 70 on a call is just simply 100% loss. Okay, go ahead, Nick.
So I was more concerned with for the $76 per share one. So where the answer is 193.88.
Mm-hmm.
In getting that answer, I don't understand why the book, or I guess like how it shows the answer at the bottom.
Uh-huh.
Why does it multiply by 100 twice? So I think
let's see. Oh.
So it says the option value, it multiplies by 100 twice. Like when I was doing it myself, I had no idea why that was.
And here's the other interesting thing about this problem. You don't need to do that. In fact, you don't even need to multiply by 100 to start with. But I'll tell you why they did it in the solution. It's not that that's wrong, right? It's just that we're carrying along a whole bunch of extra zeros that we don't need to carry along. And the key here is that if the answer is in percentage terms, even if they tell us that we are buying, 10,000 shares worth of call options, I can still do the calculation on the basis of 1 share worth of call option and get the right percentage return. So here's why they have 100 twice. They are assuming. Well, wait a minute. They don't say that in the problem. Oh, I see. Here it is. So they say you have $35,000 to invest. The premium on these options is $3.50 per share. So take the $35,000 that you have to invest, divide it by 3.5, and that means that you could buy a call option on 10,000 shares, which is, since a call option is on a stock is always in units of 100, so one contract is for 100 shares. That means you would need to buy 100 contracts worth of call options. So that's where down here, when you're actually calculating your gain, they're saying, oh, we've got 10,000 shares of this and we made $6 on each share. So that's $60,000 of total gain. Okay, and we paid $35,000 for that right. That's our premium. And that leaves us with $25,000 worth of profit. $25,000 on a $35,000 investment is a 71.43% return. And since that's on a 6-month basis, when we annualize it here, 1 plus 0.7143 raised to the second minus 1 gives us 193.88% return. Right, so they're carrying along a bunch of unnecessary zeros. So a simpler way to do that and to still get the right answer is right here. So if we take the 76 minus 70, that's our gain. $6 minus $3.50, which is our premium. So that's $2.50 on every share. And then $2.50 divide by our initial investment of $3.50. Sorry. Is 0.714286 or 71.4286%. And then when I annualize that, square that, and then minus 1. There's my 193.87% return. So I just saved carrying along a whole bunch of zeros. So that when you're answering a question like this, you can certainly answer it the way I did it, or you can answer it the way the text did it.
Okay. Makes sense.
Sure. The key is, remember now, if we're asking for gross profit and net profit, then you would have to deal with the total number of shares. But since they are not, since they're asking for a return, you don't need to worry about that. All right. Where else shall we go?
I had a question in regards to what you said about annualizing 100% losses.
Uh-huh.
Do we only not annualize that for options?
No, that would be true of any investment.
Okay, so even if it was a stock,
Yeah.
it would just be dead, so we wouldn't
Right.
annualize it. Okay.
Right.
Got it.
Yeah, just a stock goes to zero, basically.
Okay.
But it's very unusual for that to happen, obviously, right? It's quite usual for options to go to zero, though.
Okay. And then for futures pricing,
Mm-hmm.
I know that there's some really weird things where they add it up in like eighths of cents. Are we
Right.
gonna have to worry about that on the exam, or will that be like put in cents?
You could see that, yes. So, it really boils down to nothing more than this: is that the typical way it's going to be quoted, whether it's for corn, wheat, sorghum, whatever the commodity is, it's typically cents per bushel. And what you're going to see is something like this. And then they add one additional item to it, and that's the apostrophe. And you're either going to see a 0, a 2, a 4, or a 6 there, which even though they don't even tell you that in the specs when you go to the cmegroup.com website, that's just assumed that it's in eighths. So it's either $4.53 and 0.08 of a cent, $4.53 and a quarter penny, $4.53 and a half penny, $4.53 and 3/4 of a penny. So that's really the only thing you'll have to remember. Your authors will instead write it like this sometimes. So that is the same as that. So, this is what you actually see in the real world. I'm not sure why the text decided, well, let's make it more sensible. In this case, you would think that the real world would be more sensible, but they aren't. So that's really the only thing you'll have to remember.
Okay. So on the exam, we would see it in the real world sense.
Well, on the exam, you could see it either way, honestly. But you'll know, I mean, if you see the apostrophe, you know that the thing to the right of that is in eighths. If you see
If
the...
it's an apostrophe, we know that, and if it's a decimal, we know it's in normal monetary terms.
Correct. But always remember that this thing out here, that's not $453. That's still in cents. Right? It's
Okay.
so this would actually be $4.53 and a quarter cents. So if I were to write it in dollar terms, that's how it would look.
Okay. Got it. Thank you.
Sure. What else? Anything on valuation? Nothing? I'm surprised. We're only 53 minutes in. We usually go at least an hour.
If nobody else has anything, I have plenty.
I just have a quick question regarding like the actual McGraw-Hill itself. Is there any way you can unlock it where we can roam around and look at all the answers or the questions? Because on ours, it won't let me go past to the next question until I score the one I'm on.
Oh, on the practice problems?
Yeah, I want to be able to go around and look at different problems.
Yeah. I didn't realize that, and I'm glad you mentioned that. I will try to change that. Let me see if I can.
Thank you, I appreciate it.
Sure. I can't promise that I can. They don't let me do much once it's started. What I might be able to do, though, is to actually copy this. I can also get rid of 20 and 22 at that. If I do it that way, I'm a little concerned that might confuse those of you who aren't at the review, but let me go in there and see. Don't see anything there. It's probably right here. Enable proctoring. Da, 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 da. I don't know if there is. Let me see if this. Here we go. Okay. Da, 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 da. Printing is allowed. Questions are ordered. Temps unlimited. Score deduction. Anybody seeing it where I'm not seeing it right offhand. Do you see it? Do you see that, Chandler? Is there anything in here that you spot? Asking to ask the instructor is not.
Maybe in the reference type. It says
Question not
shown. Never mind. No.
No, that would be up in the drop down, I think. Access to ebook, access to check my work, unlimited uses per question. I'll dig around there after we're done. I don't want to spend your time.
Spend too much time on it right now.
Let me see if I can find some way. So what you're after is trying to be able to just jump from one question to another?
Yeah, just like look at any other question, like go around and just look at the different ones, but it won't let you until you score the question you're on.
Really?
Yeah.
So you guys don't you don't have what I'm seeing on mine here. Let me get out of here. So you don't have the ability to do this, to do preview? So I go in here and I can pick any question.
Yeah, no, it won't let
Oh, you guys don't have that. Oh. That sucks. I'll see if I can't figure out a way to fix that for you.
All right. Thank you.
Yeah. Sure. Thanks for mentioning. I didn't realize that. It's unfortunate that they don't give us a. I don't think I even have a, in Canvas I can supposedly see what you all see, but I don't think I have that option here. So I'm glad you mentioned that. Anything else out of any of the other chapters?
Could you
Carrie?
go over number 58? It's about the residual income model.
Sure. All right. So Bill's Bakery has current income or current earnings per share of $2.18. EPS. Current book value per share of $3.90. The appropriate discount rate is 13%, so K 13. Calculate the share price for Bill's Bakery if earnings grow. So G is 4%, at 4% forever. So we're using the basically the constant perpetual growth version of this. And so to do that, let me show you the way I would approach it. Let's just go to the formula. And so we can use either one of these two formulas here at the top of the page. They both will give us the same exact answer. I'm going to use the first one simply because I think that's the more intuitive version. And so EPS 1 plus G minus B0 times K over K minus G. I'm just jotting it down so when I move to this, or actually, I'll tell you what, let's go to this.
Hey everyone! Today we are going to be making some Halloween avatars on the app Boop.
All right, so value of the share is equal to the book value plus the excess that we get. So EPS times 1 plus G minus B sub 0 times K all over K minus G. And again, just for reference sake, remember that here we're unlike the real world where we think of book value as a very old historical and not very closely related to value. In this setting, we're making the assumption that book value is much more closely related to the value of the assets that we have in the company today. All right, and so that's kind of looking at what we have today, and then this fraction here is that economic value added, aka residual income model, RIM. Okay, so then we just plug in here. We've got book value. Remember, this is book value of equity, so that's $3.90 plus we've got earnings that just occurred of $2.18, and that's EPS is 0, by the way. That's a 0. And so times 1 plus the growth rate, and that was 4%. We're going to subtract from that what we should be getting given the risk level of this, and that would be the 390 times 0.13, our K, and then divide that by K minus G. And so I'm going to do this on my calculator here. 218 times 1.04 is 2.2672 minus 3.9 times 0.13, 0.507. So remember, this difference here is what we should be getting, that 50 cents, or almost 51 cents, is what we should be getting given the risk level of this investment. What we actually get is this $2.20, almost 27 cents. And so it's that excess that we're valuing here. And we're assuming that we're going to get that extra value every year forever. And then when we do the math, 2.2672 minus 0.5070, so we got 390 plus 1.7602 divide by, and so that's going to be 0.09, and divide by. That gives me, when I do that fraction, that gives me $19.55.8. So 390 plus 19.55.8, or $19.55 and 8 tenths of a penny. And so I end up with, I got 23.46 approximately. So let's go over here, and hopefully they got the same thing. Yes. Yeah. So 23.46.
Thank you.
Sure. Did that help? Did you have any particular questions that were confusing on that?
No. I just kind of wanted to just go through the steps and figure it out.
Okay. Sure. No problem. Mm-hmm. Anything else valuation related? Because residual income model is fair game. DDM is fair game. Free cash flow model, and then the relative valuations.
Can you
look over? Go ahead.
You go ahead.
Can we look over some valuations
Mm-hmm.
using the like earnings and prices and things?
Sure.
PE ratios.
Yeah. Let's see. There must be some here in the homework, right? We're on 58. Let me drop down to 59 and see if that gives us anything.
60 does.
60 does? Okay, great. Thanks. Oh, that's the one with tons of, yeah. And again, I think I mentioned this in class, or maybe not. You would never see a problem this long, right, for an exam setting. So here what they're doing is, not only do you have to calculate the actual PE and then get some sort of historical average, but you also have to calculate the historical growth rate. And then you can finally do the process. So you'll never see anything quite so convoluted and drawn out. But if you can do this, you should be in really good shape. Oh, and Dominic, I'm sorry, I didn't see that you had posted in the chat there. Sorry. So let's see where to start here. I think let me kind of wave hands a little bit on some of the things that I don't think that you'll have to be worried about on the exam, because I'm not too worried about your ability to calculate an average, right? So let's assume that we already know the averages, and nor am I that worried about your ability to actually calculate a PE or a PCF or a PS, right? We're simply taking price over earnings, or price over cash flows, or price over sales. So let's go down here and use that data and actually use that to solve for a value, if that's all right. Is does that get more at your question, Nelson? And oh, actually, Dominic already. Oh, you are here. Okay. All right. So we've got some PEs here that they've already calculated. So this first one, 97.50 cents is the price, 97.50. EPS is $3.15. So that gives us a PE of 30.95. We do the same thing for the other 5 years. We add all of those up and we divide by 6, and we end up with an average PE of 21.91. So that's my average PE. And remember, by the way, that could be a historical average for the company, or it could be other companies, comparables, and we're taking the average of the current PE for our comparables. So we're either looking back in time, all right, or we're looking cross-sectionally right now. So either one of these, we would still be getting an average PE, whether it's for the company itself and its historical, or whether it's for the 5 or 6 comparables and it's actually current. We still treat it in the same way. And again, calculating growth rates here, I'll just show you one, and then we'll assume that that's not a big deal. So if I wanted to get a growth rate of earnings in this particular setting, the first 2 years, 2014 and 2015, earnings went from 315 to 386. So it's ending minus beginning over beginning. And so that would be 386 minus 315 over 315. And that gives us a growth rate of 22.54%. We do the other growth rates in the same way. Those are only 5 intervals. So we add them up, divide by 5, and we get an average growth rate of 21.47%. And so now we use those 2 elements, the average PE and the average growth rate. And by the way, again, maybe in a problem, instead of an average growth rate, arithmetic, you might be asked to do a geometric. You could be asked to do a sustainable growth rate of some sort. So also recognize that there are multiple ways to get a growth rate. Another problem might actually just give you a growth rate. You wouldn't have to calculate it. Once we have that, then we're ready to solve the problem. We see that the most recent EPS was $8.25. So now let's go solve the problem. Oops. Let me grab that growth rate too, 2147. All right, here we go. All right, so the formula for value, and this is true whether it's PE, PCF, or PS, is whatever that average multiple is for the comparables or the historical for the company itself, times the EPS that we just saw, that's EPS 0, that just occurred seconds ago or a moment ago, times 1 plus the growth rate of earnings in this case. And so we have 21.91 times $8.25 times 1.2147 equals 21.91 times 8.25 times 1.2147. I get $219 and approximately 57 cents. And that's my share price. Are we given a market value here? I don't think we are. Oh, yeah. Oh, no, we aren't. We aren't. Now, I would do the same exact thing if it was price to cash flow or if it were price to sales. And so here we've got price to cash flow times cash flow per share times 1 plus the growth rate of cash flows. And if it's price to sales, it's times sales per share times 1 plus the growth rate of sales. And so once you get to this point, it's really just repetition. And the way to think about this, remember, if we want to maybe give it a little more intuition, remember we've got price over EPS. That's the multiple. And we're multiplying that by EPS. Oops. And there's always that implicit 1 in here. And so when we do that multiplication, the EPS cancels, and we're left with simply price. So if you get confused as to what you're doing, just remember back to this too. Hopefully that should help you remember what's going on here, rather than just plug and chug. Does that help, Nelson and Dominic?
Yeah, that helped a lot. Thank you.
Okay, good.
Yeah, thank you.
Any follow-ups or from either of you or anyone else, or anything on DDM or free cash flows? Let's see. Well, are you ready to head off and finish studying?
Just real quick, you don't have to.
Oh, sure.
Go it. But like, I feel like and I think this takes place in maybe the chapter 5 stuff. Like the questions that are asking for divisors and index.
Oh, right. That is 5. Yes.
I don't like going through that. Just did not.
Okay.
And like the 2-for-1 stock splits, like how would we see that in a
right
question?
All right.
It could be like a problem, but
Let me get out of that. I don't know. Let me just make up. We've got 3 stocks. They each have a price, 75, and make this one 30. So to get an index started, and remember that the typical way to start an index as price weighted is simply divide by the number of stocks in that index. So when I add this up, I get, 155? So the beginning value for this index is 155 divided by 3. And so that becomes $51.67, or you can even think of it as just points, 51.67 points. That's the beginning level of my index. If, for instance, let's say that stock ABC does a split, a 2-for-1, and that means that for every share you own, you get an extra share. So that means that the stock price of ABC is going to change to $25. And let's hold constant for the moment the other 2 share prices just to try to emphasize what's going on here. If I were to simply add these up, I would end up with 130. And if I were to do this same calculation here, 130 divided by 3, I get 43.33. Now, if I compare these two, what I'm seeing is, oh gee, the value of my index has dropped quite precipitously. It's dropped by a little more than 8 points. Well, in reality, the firm values in this index have not changed 1 iota. It's simply because our weighting scheme relies upon share price, and this stock did a 2-for-1 split. The other two stocks changed not one iota, nor did actually this first stock. Really, its value didn't change at all. It's just that it did this stock split. So now instead of having 1,000 shares out at 50 per share, it has 2,000 shares out at 25 per share. Same exact market cap. So the dilemma becomes, okay, well, how do I make the index level reflect that? Well, the only thing you can do is deal with the divisor. And we know that the value of the index in this second grouping here should be identical to the value up at the first set, right? So what we do is we basically force that. We say, well, the prices still add up to 130. And so I'm looking for a divisor that gives this value. All right, so I'm just taking, basically I'm solving for x. X is equal to 130 over 5167. So 130 divided by 51.67, and that's rounding a bit. So the new divisor should be 2.516. So if I divide this amount, this 130, by 2.516, I'll get 51.67. And that reflects what's really going on. Now, obviously, I could have these guys changing as well, but no point in complicating the problem here. It's only ABC that actually changed. So that's the way the problem would be stated. You could actually start off, even if they said, hey, tomorrow ABC is actually, let me give you another set of price. Maybe it's 27, CDE is 76, and FGH is 29. You could still go back to this problem and say, well, wait a minute. They did a 2-for-1 split. I know that this is actually now going to be, 25. Right? So you could do that same calculation that I just did, get the new divisor and apply it to this group of prices. So then I would simply add all of these guys up. So I would get 27 plus 76 plus 29 gives me 132, and I would divide that by my new divisor. And I would get a new index level, 2.516 of 52.46. All right, does that make sense? Okay. Sorry, my blackboard is a little messy here, but anyone else have other questions about these indices? I mean, this is probably the more complicated problem when we're dealing with indices, right? You had two primary types of problems. One was the price-weighted index, and this is the issue that we end up getting in that. The other is a value-weighted index, and that one really there's nothing much difficult to do there. The value-weighted index is quite simple. Splits don't affect it.
Can you go over how you got that 132 again?
Oh, sure. I would just add it. What I was trying to do is say, well, initially I said let's assume that on the next day prices didn't change for any of the companies, right? So I was able to calculate my new divisor. But then I said, well, wait a minute, that's not reasonable. If this is day 1 here and this is day 2 here, and the split occurred at the end of day 1, I could actually do the calculation at the end of day one. And the way I do that is to just change this one to its new post-split price. In this case, since it's a 2-for-1, it would drop down to $25. I could add that up. I'd get the 130. I could calculate my, and it's not a very, these chalkboards don't have bright colors. I can calculate my new divisor there, right? The 2.516. Then, the next day, the market changes price, and I end up on the close of that next day with this new price series right here, that ABC has a price of $27, CDE has a price of $76, and FGH has a price of $29. And then I add those three up, and that's where I get the 132. Does that help answer your question, Aiden?
Yes. Yeah, absolutely. Thank you
Okay.
so much.
Sure. No problem. Yeah, more than I'm not going to have you do pro forma, right? That you all are going to be doing when you do your security analysis, and you're going to show me what you've learned in that setting. Now, would I ask you some questions about income statements or about balance sheets that relate to the material in Chapter 19? Would that be fair game? And the answer is yes. You should have some general sense of a very consolidated income statement and a very consolidated balance sheet. But I wouldn't worry about the minutia there. I wouldn't worry about the real detailed stuff. But you want to be able to think, okay, well, what's at the top line? Obviously, that's revenue. Next thing down that's important is cost of goods sold. And then I end up with gross profit. Then I have selling and general administrative expenses, SG&A, and then I have net. That's where I have gross profit. My apologies. And then I subtract off my interest, and then I subtract off my income, or I subtract off my depreciation. I subtract off my taxes, and I get down to net income. And likewise, on a balance sheet, just have some general sense of what's going on there. What is happening with my iPad here? Oh, really? Oh, weird. Maybe that's it. That must be coming off of this chalkboard app. Sorry about that. That's bizarre. What if I shut it down? Does it go away?
Yeah, it went away.
Another reason to get rid of that app. I just downloaded it because I normally use PowerPoint to as a chalkboard, so they've got a setup here, but PowerPoint was giving me fits too. I couldn't change my pen color, and I can't get to my eraser on PowerPoint, so got to work out some of the technical details here. Sorry about that.
I think I'm good. I mean, overarching in terms of we know the problems the problems will be
Right.
from chapter 2 and 5, or from 2 and 6.
Correct. Correct.
Like the matching, I've just been terms in the back of the book just memorized.
Yes.
Definitions. That's it. We can expect to see the term that we see in the back of the book and match it.
Yep.
That's just like that.
Yep.
Yep. And then the multiple.
And there are plenty of those to memorize. So yeah, I'm not going to push it beyond that. Yeah.
Yeah, there's 150.
Yeah.
And then in terms of the multiple choice, which is the other portion,
Right.
I've really only been going back through the homework multiple choice. Really, I mean that's.
Yeah, that's good. I would say skim the chapters at least too. Skim where you feel like you have a pretty good understanding, and do a more detailed skim or a complete read in areas where you're still a little fuzzy. And that, I mean, that would be ideal, right? I don't know how much where you're at study wise, but that would be my ideal thing. That'd kind of be the last thing that I would do. The other, the other thing I find about taking an exam is, quiz yourself and go back over things. I find that helps build some confidence in your knowledge, because I'll never forget walking into an exam in econometrics with Dr. Ken Kroner, my first year as a doctoral student, and I thought I understood the stuff. I was doing all right. Ken Kroner is a brilliant econometrician. He's now also a multimillionaire because he went to, I think he's at BlackRock. I don't know. Maybe he's retired by now. He should be. Anyway, Ken liked to mess with students, and Ken messed with us, and I did not do very well on the exam, and I lost some confidence in my ability to do well, and I found that, going back and testing myself and saying, yes, I got this, and then even if I missed something, I would review how I should get to the right answer and feel like, okay, I got this. Keep just, telling your, kind of rewarding yourself for getting a right answer, and recognize that you do know this stuff. You really are going to do all right. And, believe it or not, that really helps reduce some of that stress level when you hit the test. Or at least it did for me.
Thank you. Yeah.
Sure.
So the definitions we have to know, they're the key terms at the back of every chapter, right?
Yes, that's correct.
Okay.
Yep.
Just making sure.
Mm-hmm. Yeah, and they're scattered throughout the chapter too, but the easiest spot is the back. They're all listed in one page. Just click on each term and it pops up a little pop-up window, and it gives you the definition.
Awesome. Thank you.
Sure, you're welcome.
And you'll print out like the formula sheet, right? We don't need to bring one printed out.
I will. Yeah, and then that way everybody's got a clean blank, or just the formulas themselves that I put on there. So feel free to make notes if you want on your copies.
Awesome. Well, thanks for taking the time.
Sure.
Head out, but have a good one.
Thanks. You too, Nick. And anyone else have questions, or do you want to get back to studying?
So would you feel for the multiple choice would be kind of like an even distribution of conceptual problems with like actual mathematical problems? Or would you say it's scaled in favor more on one side?
No, I'm going to try to be about 50-50 on those, and I'm trying to split them across the chapters. One exception, chapter 1, is going to be a little light because I don't expect you to memorize dates. I really don't care whether you know the exact dates of something or another, or, what's the return been on equities since 1801? That's crazy. You don't need to remember that stuff. So there'll be, chapters 2, 3, 5, 6, 19, and 20. Those will be as equally weighted as I can make them, and about half conceptual, half analytical.
All right, thank you.
You're welcome, Nick. Anything else? All right. Well, feel free to email to me if you have any questions that pop up. Otherwise, I will see you all tomorrow, and good luck. Happy studying.